Hello, YouTube. Is the stock market ready to go higher? We now have a bullish pattern setting up if we can get some follow through. What I'm talking about specifically is that we have 4 weeks of higher lows, low, higher, low, higher, low, higher, low. And we also have higher highs getting set. We got high, higher, high, higher, high for the last 3 weeks. And now this week we have a full inside bar, which just means that we've traded within the range from the previous week. As we have some really big economic data coming out this week, our goal is to try to understand whether or not this pattern is going to be reliable and where we're likely going to go if we are carving out a bottom. So hopefully you enjoy this weekend video. If you are, please smash a thumbs up, drop me a comment. And if you've not already, please subscribe to the channel. We put out videos literally every single day other than Sundays talking about stocks, commodities, crypto, technology stocks, and everything you need to know to be prepared for the week ahead. All right, let's have a look at a couple articles. Then we'll come back and have a look at this chart here. So this is from Thursday. So S&P gains for fourth straight day to match year's longest winning streak. Dow Jones jumps 300 points. So what's really interesting is that on Friday, we were looking for that hot streak to continue with one more green close. We did close down by 32 cents on Friday, or 0.08%. Which means that we are right at the we're at the best win streak so far for the year. And after an indecision on Friday, I would say that if we're going to be getting a bull break or we're going to break this downtrend and start going back up, that is likely what we're going to be looking for. It's going to be follow through momentum. We're closing near the high of the week, and we just want to see us crack that downtrend and start going higher. That's the first thing. So the next thing I want to do, which I did last week and people seem to enjoy, and again, drop me a comment if you have commentary. I'm going to look at the key dates for this week, and then I'm going to explain my bull and my bear scenario for where we could go. So this week ahead, we have quite a bit of data. You're going to note a lot of things are underlined, which just means that, yeah, we got a lot of really important data coming out this week. If it's bolded and underlined, it is more important. So on Monday, we got John Williams speaking about LIBOR. Probably not going to really move the needle. On Wednesday, that's a big one. Pre-market, we got CPI. On Wednesday, we also have a Bank of Canada rate decision where they are widely expected to raise by 75 basis points. On Thursday, we got initial jobless claims coming out at 8:30. Then we got PPI, or the Producer Price Index, coming out at 8:30 as well. On Thursday, we're going to be kicking off earnings. And on Thursday, we also have Q2 GDP on a year-over-year perspective for China. And then on Friday, we have retail sales. And then finally, on Friday, we also have OPEC. So this is going to be a really important data week. And as I just noted before, we're kind of at an inflection point where we're either going to keep going higher or we're going to break down and finally test that 200 weekly moving average. So if we now think about why this would be bullish or why this would be bearish, I'm first of all going to point out where the data starts to really get heavy. It's going to be on Wednesday here at about 8:30 a.m. So here I have a chart, which is going to be an hourly chart. And we can note that the blue lines signify that we've been spending most of the year going down. Notably, since April, we've been in a funnel lower. A little bit of time below, a little bit of time above, but for the most part, range bound inside this area. So now that we're finally looking to break out and we have a W formed inside of here, if the bulls are going to win, we can't just rest here. We actually have to continue higher and look to fill that gap at about 400. So the important thing for me here is just that as we zoom in, we can note that we are resting just below the 200 hourly moving average. So we've been unable to claim it and hold it for quite some time. We note that we lost it back in April, retested it, lost it, retested it again, and now we're gathering up steam to try to break it. What's most important to me is that here at Tuesday at 3 o'clock is where we have our apex. I'll throw an arrow here so you guys can see what I'm talking about. And all this means is that we're trying to stop going down, meaning we're trying to break our blue funnel and we're trying to go back up. So if we're going to go back up, we have to get above our long-term average on the hourly chart before we're going to break bullish on the daily chart. So here we can note that at Tuesday at 3 o'clock, basically the Tuesday close, if we are above or below 390, that is our indication as to whether or not the bulls or bears are in control. And then we'll have the confirmation on Wednesday pre-market, which means the Wednesday open. That's why Wednesday is going to be really important. It's the first bolded and underlined data point here. And now I'm going to close this out to save some memory to record without lag. And now we understand that 200 hourly moving average is really important. Next thing I want to look at here is just going to be the daily chart. Actually, before I look at the daily chart, I also just want to have a look here at the weekly chart. So let's get this one out of the way, and then we'll look at the daily chart to try to understand, and then we'll come back and talk about the bull and bear scenario. So looking here, again, we have a reversal attempt. The price action is bullish if we can break this downtrend, which would mean basically breaking above last week's high. If we can get above 394, that would take out all these relative highs, would also get us stop going down by meaning breaking this blue downtrend. That's the first thing I'm going to be watching for. So since we close at the high of the week, I would be looking for immediate continuation or reclaiming that 200 hourly moving average. And we also note here that I have a Fibonacci retracement going from the all-time high all the way down to our low. And this level right here, the 23% retracement, is 390, almost exactly. So that 390 is going to be very important because it's our 200 hourly moving average. It's a nice round number. And it also is where, if we're going to retrace this whole move or go back up to the high, we have to first of all take out the 23% retracement before we look at the 38% retracement at about 407. That level is also important. So that's the first reason why this 390 is where we're finding a lot of resistance. It's the first retracement level. Second thing I would notice that the volume profile over here, the volume profile pretty much takes the volume that we have on a daily perspective, but actually adds it to the price. So now we can see that the biggest pockets of supply, or the biggest bars here, come in at where? They come in right at 390. So yeah, people want their money back. And on previous videos, we've gone through and talked about how the 1 trillion that's flowed in so far year to date, we did see a little bit of outflows on the most recent rally last week. So again, another reason why we're having some resistance here. However, if we can take out this current bar, where are we likely going to go next? All the way up here to the next supply pocket at roughly what? It's at roughly 410.64, which is going to be our February low or our second quarter low. That's really important. So if we can snap over to, again, 390, I could see us going to 400s in a hurry. Next thing I want to look at here is just going to be that the volume does not really confirm the move. So all the recent volume is red. So although we have a reversal attempt and a bullish possibility, we do not yet have the confirmation. And I think a large part of that is because there's so much data coming out this week that by the time we get to Friday, we're going to have a very clear picture on where the market's likely going to go. So there we go. I'm now going to remove a few more things, and we're going to look at our daily chart, and then I'll go through and try to explain my bull and my bear thesis. All right, so now let's pop over here to our daily chart. And next thing I want to look at here is, again, this is going to be a daily chart. And I'm going to start off by talking about the bull scenario. And here we can look at, first of all, just that we have a W forming. So previous times we've tried to rally up. I'm actually going to delete the W first so we can focus on the first thing that's important here. And that is going to be this uptrend. The uptrend we formed right here. So massive low gets established on what? On big volume. We stage a low, a higher low, and then we slingshot up. So what do we have formed over here? We kind of got that same thing where we got the low, the higher low, and the higher low, and then we're trying to slingshot up. So this is able to complete, again, we'd be looking for that same pattern on the hourly we just looked at, or a W for the bull. So if a W is going to complete, we should be able to make it all the way back up here to about roughly 420. That would be an upside target. Again, a lot of this is going to depend on how the price action shakes out by Friday, but this is the bullish potential. I'm now going to go through and have a look at the data points to try to support the reasons why we could see a bull scenario this week. So if CPI comes in at expectations or below, that could be signaling that we are at peak inflation. We also note that the Fed is also seeing that we're potentially seeing some peak hawkishness. And the reason for that is because we are seeing that we have a data point. I'm actually going to jump forward here for 1 second. Just to make sure I can tell my story. This right here, so we can note that the green line is going to be the FOMC dot median projection, which means that they're expecting us to peak on peak on interest rates going into 2023, and then lower in 2024, and then lower for the longer term. So the reason why that's important is just because Jerome has been communicating to us pretty clearly in terms of what he wants to do. So if the market has had a chance to properly discount where we're going to be going, that can mean that if CPI also comes in either at expectations or not at least going up massively, that could signal that this could be the end of the cycle. Other reason why this could be bullish as well is because we're going to be getting earnings season kicking off, and we're going to be having banks really lead. So when we look here to what is going to be leading, we look at the economic calendar here. The earnings calendar. We can note that Pepsi, Delta come out, but they really start kicking off here on Thursday with JP Morgan, Morgan Stanley, And other banks reporting on Friday, like Wells Fargo. I'm not sure where Goldman Sachs is. What happened here? Let me bring it back up. My point is just that these banks are going to have a much better picture on the economy than we do. So if we're going to be bullish, we're probably going to find out by Friday. And then lastly, monthly OPEX. There's also a reason in terms of the options for us to try to go higher. So let's have a quick look here and see what the options chain looks like for next week, because when we did the Friday stream, we were talking about how there was options gushing at 390. Oops, wrong chain. Let's go to the one from Monday. And there is massive continuation, which means that the bulls who were there on Friday and for the large part of the week are bullish not just for this week, but continuation. So, let's make sure we actually use a color here. Pink usually stands out. There we go, 390, 176,000 in volume. If that converts to open interest over here, that'll be quite notable. This is for Monday, so people are expecting immediate follow-through on Monday. We can also note the premium attached to these options, somewhere between 150 and 250, which would mean what? We're pretty much going to be making a new high the week versus last week. That inside bar should break bullish if these are going to pay up. On the put side, we do have 390 all the way down to 385, and 385 being the busiest strike. So 385 is also quite important. What we want to make sure we pay attention to, though, is the story or the theme in terms of where we could go. So now we're going to look here at the Wednesday chain, which is going to be important because we have that CPI print coming out. This is going to be people positioning for that CPI print. Here we're looking and noticing that we got continuation at 390 up to 400. A little bit at 395, but no open interest, so nothing above 10,000 here. On the put side, we have 390, 388, 385, all the way down to 378. This is pretty busy. For Wednesday, it is definitely skewed a little bit more bearish. So again, that's likely due to the CPI print coming out on Wednesday. But now if we look to the monthly chain, which happens generally on the third Friday of every month, here we can note that we're looking at the monthly chain for July 15th on the 16s. And what I'm looking at here is mostly open interest. So here we can note that we got 390 to 395, but the open interest is only really big at about 390, which means that bulls are not really motivated to hold. If we look on the put side, we can now note that we got 395, 392, 390 with volume, actually. Lots of volume here, volume of 389, and we got tons of volume of 385. So it looks like the bears are actually more motivated, but it does not mean they're going to get paid. If the option sellers are able to hold us above 385, maybe even 390, it means that they're going to collect all the premium. So that could be the bullish motivation for us to continue. Last thing to look at here is going to be going out to July monthly to see whether or not people are already positioning for the next month. Sorry, the August monthly chain. So what I generally like to do is look at the next monthly chain as we are set to close out OPEX. And here we can note that we got, we got 390, we got 385, we got 382, and only two strikes have anything over 10K here on the call side, 390 to 395. All right, there we go. That is the bull scenario. Now we're going to look at the chart to see what that would do. So we know we got the W. We know we got all these things. We know we're trying to form a base. And again, bases form over time. It's not going to be like, oh, it's right now we're forming the base. We'll realize that in hindsight. So now that we also understand the significance of the 390 area from the weekly chart, we can also note here that we have a gap. So we got this big fat gap here. And we tested it once, backed off, tested it twice. And if we're able to break above it, that means that this is now going to act as support. If you remember, this area here is where we were seeing very aggressive short selling. So that means that the second leg down, the bears are actually underwater, or means that they're losing money. We don't have a lot of volume, which means that it's not chewed through all of it yet. But if these bears start unwinding their positions, we're going to find that out probably on Friday when we get the CFTC data in terms of net long and net short positioning for most major futures. So anyways, if we're able to snap above 390, the next natural area is going to be at about 395, or our next gap here. And what's also very interesting is that our 50 DMA is curling down really fast, which means that we're going to have that 50 DMA roughly aligned with 396, or the beginning of our gap. So I believe that we're going to hit this here, back off, punch up to the next level here, or fill this gap. And then if we backtest the 50 and pass, we should start advancing higher. That is the bull scenario. That's how the W gets formed. So again, one more time. If we look here to where we are right now, if we're able to break and close above 390 for 2 consecutive days, I believe We're going to hit that 50. We're probably going to back off somewhere between 393 and 390, gather up steam, break over the 50 DMA, fill the daily gap, back test the 50 DMA, which is going to curl down. And then we're going to start legging higher. What this would ultimately do would be to fulfill our stock market psychology chart here, where we can note that we are looking for a massive dead cat bounce. This now goes back to June 18th. And here on the right, we're looking at a specific pattern. So we're going to look and see updated where we were. Last time we checked in, we were at 365. So if now we come back to here and we look at our monthly chart for SPY, we can now know that, right, we're trying to carve out a bottom, right? We took out the relative low. We do have to make it up here to our uptrend at about 407. Remember that number we just talked about? Yes. So that's what I'm really paying attention to. So going into the end of the month, are we able to snap back, reclaim 400, and then push up to complete our pattern? Because when we look here, there is potential for us to snap off if we're able to claim the pink line or the uptrend, go all the way back up to the red line, which would be our neck line from our head and shoulders. That's all the way back up here. So that would take us all the way up here to about 460. And the reason why this is important is because if we now look at one more thing, so actually let's make a mental note of that number. It's 454, right? 454, I believe 454.05 is going to be that head and shoulders neckline. Now, if we go back to our weekly chart, the reason why this is important is because if we're truly exiting the bear market and entering a new bull market, what I need to see for confirmation is going to be a very simple indicator. We actually had an educational course on this week. So what I want to see is, I think we got close enough to this 200 DMA, which is where we generally see the Fed put. And now what I want to see is us actually reclaim this 50 weekly moving average. Right now that's at 437.39. So if we're going to invalidate this pattern, and meaning we're going to break bullish and not just stall out at 454, meaning if this is the start of a new bull market because we saw peak hawkishness and we saw peak inflation, we should be able to reclaim that 50 weekly moving average, no problem. And the way that could happen, if we look back in history, is, again, going back in time, we can note that every previous time we've contracted, I want to go back to 2008 and 2000 because this is really the example that really matters here. So, right, we lose the 50, we lose the 200, we dead cat bounce back up, fail to reclaim the 50. What happens? Fresh leg lower. Same thing in 2008. We're above the 50, we rock, bump, 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 right? Eventually, we lose the 50 over here. We come down to lose and test the 200. We bounce off. But what do we fail to do again? We fail to reclaim the blue line or the 50 weekly moving average. And what did that do? It led to a big old nasty drop. We only started actually expanding or going higher after we reclaimed the 50. And then what, right? Uninterrupted expansion, bounce, 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 bounce. Same thing here in 2008. So if we're not able to get above that 50 weekly moving average, we're probably going to have more downside. So finally reclaims it, right? Bounce, bounce, bounce. And on previous times as well, when we actually have that dip, including 2011 and 2016, when we do fall below the 50, test the 200, reclaim the 50, what happens? An uninterrupted bull expansion, where we now note that, again, from roughly 120 to, right, 200 plus, that's an uninterrupted expansion of roughly 100%. Over the 50, bounce, 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 bounce. And then what happened again in 2016? We lost it, got close enough to 200, but not quite testing it, getting quite close here. Let's zoom in to see what happened. Pretty close. And then again, reclaim the 50, bounce, bounce, bounce. And if we zoom out from 2016, that was a really nice expansion. So we note here, we form our bottom in 2016, reclaim, bounce, 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 bounce. And then 2018 happened. Same thing here. Lose the 50, test the 200, get back above the 50, and then what? Uninterrupted expansion. Let's call it a bull market. So, right, bounce, bounce, bounce. Same thing in 2020. This one did cut quite a bit below the 200 monthly here. Sorry, 200 weekly. So we note here that we lose the 50, lose the 200, reclaim it, reclaim the 50, and then what? Uninterrupted expansion. That's been the last 2 years, by the way. So, right, now we note that back above the 50, bounce, 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 lose it. So now the big question is, if the bulls are in control, we can't just go up to 400. We have to reclaim this 50. We have to hold it, and we have to keep making new highs. All right, there's the bull scenario. For the bear scenario, it's the exact opposite. The base case is that we're going to have an earnings recession, and that's going to be kicking off this week. So banks could tell us that we're going to be having a really big shock in terms of more companies defaulting. We can see that CPI is not slowing down, which means that we don't have peak inflation. The Bank of Canada forecasts that we're going to be getting a 75 basis point hike in the U.S., meaning it's going to be a preview. The options chain is already very skewed bearish, meaning that there's much more open interest for the bears, which means if they're going to make a stomp, they're probably going to make it into Friday, which is going to be that monthly OPEX. They also have bearish continuation through to August. China GDP, well, again, we know that the Chinese government has been stimulating their economy. So if we look here at FXI, they've been stimulating because they're actually facing some shocks in terms of growth. So what is that? Well, it might be a preview for what could be happening. I don't know for sure what's happening in China, right? I'm not a China expert, but injecting liquidity usually happens when things are bad. So if we're going to see a negative GDP print from China, which is the world's growth engine, that would be a really nasty surprise. Retail sales are really important because they make up 70% of the GDP for America. So again, we get a negative number from China. 70% of American GDP is from the retail consumer, right? So if now we note that China on Thursday tells us that, right, oh my God, we're not actually growing as much as we thought, which means the whole world is probably not growing. Retail sales for America confirm it as well. That would be the bearish setup. And then on next Wednesday, after we have initial jobless claims on Thursday, right, initial jobless claims, the Fed already knows that we can raise by 75. And the reason they can raise by 75 is because they're scared about people losing their jobs. And we saw a really strong jobs number on Friday, which means that we actually added roughly another 100,000 jobs than expected. So the Fed, at least for what they care about, has the green light to keep hiking. And when the Fed keeps hiking, generally they will break something. So let me actually pull up one more thing I didn't have prepared. Actually, two more things. So the St. Louis Fed is already telling us that we're in recession. Oh man, they actually updated it now. Q2 is at negative 1.2%, updated July 8th. That is updated as of yesterday. So oh wow, actually I didn't even notice this until now. Last time I checked, it was at 0.2. Now it's at negative 1.2. That's a decent sized contraction. I think we contracted by just under 1% in last quarter. That'd be a technical recession, 2 quarters of negative contraction. We can also look here and see that historically the Fed funds rate, basically meaning what the Fed charges for inflation, this is going to be important here because we're at the point where they generally break something like they did in the 1980s, right, 1987. So just looking at these areas here, every time we hit this downtrend, something breaks, meaning the financial system has some stress, and they have to reverse course or start lowering interest rates. This will also be important because we have an auction, a 10-year bond auction coming in on Thursday, I believe. I did not include it here because I don't think it's really a huge data point, but it's something to pay attention to. So our bearish scenario would be that, if we now go back to the chart, our bearish scenario would be that we're in a dominant downtrend. Let's go back to here, right? Our bearish scenario is that pretty much we're going to be having an actual recession along with an earnings recession. That would be very negative. It would be a very negative overhang. If we now look at the chart, let's go to SPY. Let's look at the 1 week. It would mean that we're going to fail to break here higher. That demand pocket, the supply pocket where people want to actually sell is going to overwhelm the bid because we got low volume. And the bears are going to reposition and stomp the chart, which means that we're probably going to maintain our existing trend here and then land here going into Labor Day. Again, sell in May and go away and come back on Labor Day. Labor Day is going to land right here at our downtrend and the 200 weekly moving average. And it also means that we're not going to make it through this current supply pocket. That would be the bearish scenario. If we look over here at the daily chart now to try to understand what that would mean on a shorter time frame, pretty much means that even if we do overshoot to here, we're not going to go above the 50 DMA. We're going to leave this gap here, and then we're going to resume our trend down, right? Probably making new fresh lows, going down to our ultimate bear market targets of roughly 350, which is going to be our 50 monthly moving average. So our 50 monthly moving average aligns with roughly 350, also aligns with the previous 2020 top, and then also aligns with our 200 weekly moving average, which we just spent a lot of time talking about. So at a very high level, that is how we could have a bullish and a bearish scenario for this next week. I think we've already talked about quite a bit of stuff, so I'm going to push forward and just continue the show here. So now we got a few more things here, bringing my board over. Let's see what I got. So again, I don't really want to talk about the 2008 and 2000 comparison that I've made before, but what we have to be aware of now with that bear scenario in mind here is that we cannot really afford to stall out here. We have to start going higher. If we're going to repeat 2008, all we have to do is just not go up, and we're probably going to get that leg down. Again, that means that we're not going to reclaim the 50 weekly moving average, and ultimately we're probably going to be going for a negative 50% cut. A few more things here in terms of economic data that are important for us is that, again, historic cascade of default is coming for emerging markets. And what this means is that there's roughly $500 billion right now that is, again, lended to third world countries, which are not really able to afford to repay it. Sri Lanka actually saw their prime minister ousted. He resigned, and they stormed the capital, right? They overthrew the government because of inflation. So if this starts to spread or have contagion for the rest of the world, this could be very negative. Again, I don't want to get into the specifics of it. Hopefully you guys understand what this means. It just means that there's a lot of people who owe a lot of money in emerging markets, and it does not look like they can afford to pay it back. And now they are feeling the need to revolt because they cannot afford to buy everyday things. A few more things here to look at in terms of economic data is just that, right, the jobs report gives Powell a little more runway on rates, which means they're going to probably front load rates, 75 in July, 50 in September, and then maybe even more. Just in the last roughly month or two, we've now been told that the end of year rate for 2022 is likely going to be 3 to 3.5%, where before we were looking at 2 to 2.5. So that is a huge change versus before. They've raised it by roughly 1%. We can also note here that the B of A bull and bear indicator remains at extreme bearish territory for the fourth week in a row. However, we've been carving out a bottom. So looking here at the chart, again, over the last 4 weeks, we've been carving out a bottom. I think the reason why this indicator is still so high is because people have been shorting, right? They've been shorting here, and now they don't want to admit they're wrong, which means that they're going to say that we're actually still very bearish. So here we go. Anyways, moving forward. Right, we saw inflows into cash, right? Inflows into bonds, biggest 14-week billion from equities, which means we saw outflows. Anyways, moving forward here. Goldman slashes GDP forecast for the second quarter to just barely above water. And again, we just looked at the St. Louis Fed. They actually have it at negative 1.2. I'm actually going to make sure I keep that in mind here because I'm going to want to share that after. All right. So Goldman says we're going to lower it. Again, here we note that we got the dot plot revised. Next thing is earnings. So earnings are going to really matter. And the reason why they're going to really matter is because a lot of companies are currently expecting that things are going to be a little bit less rosy tomorrow than they are today. So if we now have a look at one more data point, I want to have a look here and see, just 1 second here, let me pull it up. What I'm looking at here is just the, again, corporate margins versus consumer sentiment. So here we can note that margins are at extreme high. We've diverged significantly. The lines usually move together. Now they're not. So something has to give here. These margins are likely going to have to come down. When are we going to hear about that? We're going to hear about that during earnings season. So that's what I'm expecting to hear on Friday from those banks if we're going to be bearish. There we go. Finishing off the story here. Now we can note that we also have one more thing over in Europe. So Putin is set to halt gas and Germany fears it's not coming back. Oh man, that sounds scary. Yeah, Germany's already expected to go into recession, and this would be very negative. Scholz, the person who's the leader in Germany, is saying that they vow to shift. Energy shift will help Germany remain industry giant. This just looks like there is potential for a nasty surprise, and that's all I really want to talk about here. You guys can understand what this means. Finally, the rhetoric from the ECB. So ECB's Holtzman foresees steep rate hikes to stem fast inflation by as much as 125 basis points by September. I think that's very wishful thinking. They've not had real interest rates in Europe for roughly, I don't know, like 10, 15 years. So again, there's a lot of things that are shaking out here. Maybe now you have a little bit more of context in terms of how these key dates are going to shake out for the week. There we go. A few more things to look at are going to include the psychology chart here, which we already talked about in terms of whether or not the bulls or bears are in control, what exactly that is going to mean. All right, next thing here is fear and greed. So stocks generally bottom on bad news. So if we're able to continue to go higher by Friday, even with all of this potential bearish news, what can happen? We could go higher. Why? Again, stocks generally bottom on bad news. So that's what I'll be paying attention to. We're now exiting extreme fear and now only into fear. Next thing I want to look at here is who actually rallied in the last 1 week, because if we are carving out a bottom, we're probably going to see the leadership start emerging for the next bull market. What do we not see going up, first of all? Energy, utilities, a little bit of healthcare, right? Process and industries, communications. Yeah, that's exactly what I would expect to see if we're going to be rotating back into a bull market. If yields have peaked, we should see technology going up. Tesla up 10, Amazon up 8, which have been the biggest laggards so far this year. So the greenest blocks are the ones I would like to see if we were going to be putting in an actual bull market. So chips are leading tech. Actually, tech is leading chips, and tech is leading SPY. So I want to see these chips outperform. And we can already note that Bitcoin and Ethereum are attempting a comeback. If we now look at year to date, we can note that there's a couple stocks which have exited bear market. So Google out of it, only down 18. Apple only down 17. Microsoft down by still 20. Tesla only down by 30. Amazon only down by 30. They were down by 40 or more before, so it's looking a lot better. So the leadership of tomorrow is looking like it would be the strongest companies. Again, making sure that if all this actually plays out. So with all that in mind, let's have a look at a couple more charts, and then we're going to wrap up the video and make sure you are prepared for this next week. One more thing that's bearish actually is just the yield curve here. So we can note that we still have inversion, which usually signals recession. The 2s and 10s are still inverted. The 2-year note's at 3.11, 10-year note is at 3.08. What I want to focus on here are going to be looking at weekly charts just really fast. So looking at SPY, we did a lot of research on this one here. We talked about it extensively. Just has to stop going down. Needs volume too. QQQ, 29658, 29675. That's a higher high and a higher low with a pivot offer negative 30%. Looking for us to reclaim that high at about 302. So looking for S&P to get above 400 and QQQ to get above 300. DXY, it's closed above a multi-decade area. So 106.56 is a really important area. And if we look all the way back in time to 1987, we know where that number comes from. It's all the way back here, 1989. So the dollar is breaking out. It's got that same W we pointed out on SPY. And if it can keep going, there could be a lot more pain here. So on the monthly chart, if we break above this neckline, which again shows us we have like a massive head and shoulders, if we're able to break above there, we could go up as high as 120. 120 would add a lot more pressure to stocks. That'd be about 14% decline from where we are right now. So 388 times 0.86, a 14% decline on SPY would take us down to 333. That would definitely sting. Looking at the VIX, looking on a weekly chart, Golden Cross, cup and handle, back testing the 50. It's back to mid 20s, so watching that closely too. Volatility is actually coming down. The Bitcoin is now tested its 200 weekly here at 22,500. It's backed off. I want to see that claim. This is one of the riskiest assets. They got big bearish volume. If we're going to stage a reversal, we have to bounce off this 2018 top. Cannot afford to stall out here. Same thing with Ethereum. Trying to actually currently above its 200 weekly at 1210. Just want to see it actually break above and hold. Trillion-dollar companies, right? Apple looks okay here. Trying to rally up. Looks pretty good compared to the others. Microsoft, again, the one that has to exit bear market territory, just needs roughly an extra 1% to exit that bear market, and that would take us above our relative low, stop going down, and we're looking for roughly 270. Google, bullish engulfing candle. Looks like it wants to do the same thing. It wants to stop going down if it can rally roughly another 2% to 2,500. Amazon, staging a comeback. There we go. Still below the 200 weekly, though. Tesla, trying to rally, stop going down. Elon has now canceled the Twitter deal. Let's see if there's juice to this rally. Meta, stinky. Want to skip that one. Nvidia, again, the chips need to also stop going down, which means we got to get above 165. Really big area here. Finally, I think that's it. I think I'm actually going to leave it there. We don't have to look at all the other charts. So with that said, I want to thank you for watching. If you've enjoyed the video, I would really appreciate if you could smash a thumbs up, drop me a comment, and let me know what you think the market's going to do this week. If not, thank you so much for watching, and I will include a video to my original bear market thesis from the beginning of the year if you want to know where we started from and how we got to where we are today. Otherwise, thank you for watching, and I look forward to seeing you on Monday.